we've got three really interesting themes, I think, to talk about today. Frontier markets with Oliver Bell from T. Rowe Price, infrastructure with Nick Langley from Legg Mason and from Rare, and Hannah Johnson from BlackRock to talk about the future of transport. So I'm going to start off with Nick. Talking about infrastructure. Now, infrastructure, Nick, has been a really interesting area for the last couple of years now. It's provided some very attractive returns for investors. Where are we today with valuations, and how does the outlook set for the next couple of years?
Yeah, sure, Ryan. So we track valuations, obviously, and we look at the enterprise value to the EBITDA, earnings before interest, tax, depreciation, amortization. So think of it as cash earnings. And it's the ability of the infrastructure assets to generate cash flows over the long term that's really important here. And what we see today is they're at the top end of the trading multiple range since the GFC. They've kind of sat between 10.5 times and 11.5 times. They're currently sitting at 11.3. But what we are seeing behind that is very strong growth in the underlying asset bases of these companies. We see the utility companies, the electric, the gas and the water, slowly getting more expensive, and part of that is a cost of capital issue as bond yields are coming down. We'll talk more about that later in the session. And then on the infrastructure side, we're actually seeing quite stable valuations there as the market worries a little bit about growth over the longer term, and those companies tend to be a little bit more economically sensitive. So, particularly on the transport side with the road companies, they have been pretty stable in terms of their valuations, certainly over the last few years.
Great stuff. Nick, you mentioned transport there, which I think segues quite neatly to you, Hannah. What is that? What does that mean, the future of transport? And actually, maybe you could outline what is the future of transport as well to set the scene.
Okay, so I believe the future of transport is electrified, connected, and autonomous. But obviously, the future of transport is also the name of the fund that I run at BlackRock. And so it starts probably with the electric car, where we've seen a huge push into electrification in China. But in Europe now, we're at the epicenter of the electric car. So we're expecting huge growth next year, lots of models ramping up. But it's not just about the electric car. It's also about safety, where cars kill 1.5 or 1.25 million people a year. That's double the amount that malaria, and we have the opportunity to make some real groundbreaking ADAS technologies, and that also leads to autonomous cars. And I'm sure we heard in the tech speech that autonomous is going to change a whole bunch of different business models.
In the name of Hannah's fund is the future, and I think one of the interesting things when we think about frontier markets is that is all about the future. There. Maybe interesting just to set the scene for frontier markets and where the direction of travel they are, and maybe for the audience as well, perhaps talk about some of the countries that are actually part of the frontier index.
Assuming you've got exposure to emerging markets, you've got exposure to about 50 countries worldwide. Frontier markets are the other 150, and they're the ones that are growing the fastest. They've got the fastest growing populations. They have got the preconditions, if you like, to start launching themselves in terms of development, similar to emerging markets maybe 20 or 30 years ago. So I'm talking about Africa. You need a secondary education rate of around 70% in order to make sure that middle class comes through. Most of African countries are getting there. So you're actually, in the next few decades, going to see quite a substantial change in the demographic and the GDP per capita of the population there. On top of that, with the population growth, 1.2 billion Africans today will become 2 billion Africans in 2040. So one needs to bear in mind that this is going to become a very important part of the world. But it's not just Africa, it's parts of the Middle East. It's in Asia, you've got Vietnam, Sri Lanka, Bangladesh. In Latin America, Argentina, you could argue maybe Peru. And then Central Eastern Europe, the Stans, Georgia, Romania, Kazakhstan, etc. So it covers a broad spectrum, and these are the countries that are perhaps the sources of cheap labour in the future, and they're countries you can't really ignore going forward.
An example of a attempted new entrant into the car market that tries to take his knowledge from building our Hoovers into building a brand new car, and he's unusually given up, it seems, because it's just too difficult. How easy is it to break into a market like the car market?
Okay, so it does require quite a lot, right, of capital to produce a car. Dyson definitely had very lofty ambitions, but they've still done quite a lot of good research that they're now trying to sell to various OEMs, but they've stepped back from the idea of building an entire car from scratch. And I think that's kind of interesting. It shows where the market is right now. We're moving back towards some of the traditional OEMs taking leadership positions, actually, particularly VW, who are building 8 electric vehicle plants. They're going to launch a lot of new models next year. They launched the ID this year. So I definitely think, it is tricky, and you have to be nimble. If you're, operating in an existing business where you're just going to see quite a lot of growth from the EVs, it doesn't matter if it's a new entrant who's providing that growth like Dyson, or if it's an incumbent like VW, you're still going to grow the number of batteries or the number of, cameras or whatever that you sell. So I do think it's difficult, but we are seeing quite a lot of new entrants, particularly in China, where there have been companies like Byton or NIO, or all sorts of interesting new companies launch. I think we are going to see change, and the drivers behind what is driving electric vehicle penetration, which is this dual combo of technology and then also regulation. And on the technology, I would sort of be remiss to not talk about the new entrant that is Tesla. So a Tesla Model S can go from 0 to 60 in 2.4 seconds, which is pretty cool. It's faster than any Ferrari, for example. And Tesla, as a new entrant, has really sort of disrupted the market in the US. So when the Model 3 launched in Q3, they actually outsold all of the other premium brands selling in the US at that time, like Audi or Lexus or whatever, added together. And that's premium market is where the OEMs make all their money, premiums and SUVs. So it's just incredibly difficult for OEMs to sort of do that. So they've responded to this sort of technological new entrant by launching all these new models that we're going to see in Europe.
If we take a bigger picture around the world, we're perhaps moving to a world that's perhaps a little bit more protectionist, a little less global. How does frontier markets grow in that environment where perhaps they haven't got the same accommodative route that perhaps the emerging markets of today have?
I think we're always going to need cheap labour to build something. Now, what that something is will probably change, and maybe, we've heard about supply chains for electric vehicles. They're not set up yet, so where are they going to set up now? And if you look at what's going on with the US-China trade spat at the moment, the biggest beneficiary is Vietnam. So Vietnam already was on a wave of foreign direct investment into their manufacturing sector. Their labour costs are still about a third of that of China's. The productivity is very similar. Indeed, I was in Intel's offices in Vietnam, and the CFO there told me that their Vietnam plant produces the chips more efficiently than they're outsourcing. So it's a very good destination for incremental manufacturing. On top of that, go back 5-10 years, their biggest export was textiles. It's now Samsung mobile phones. And again, a company that's had an amazing experience in Vietnam is quadrupling their investment into that country. So there are beneficiaries. Bangladesh is the next one, very big country, still more on the textile side, but starting to put the infrastructure in order to build the manufacturing capability, the value added. So I think there's always scare stories about what are people going to be doing, but actually we just move to where the jobs are needed, or the products are needed, and businesses look for places that are the least cost, if you like, for building those.
Fun fact for the day, the US-China trade war is expected to result in an 8% bump to Vietnam's GDP within a couple of year period. It's just extraordinary.
It is, and I guess it makes a large part of the frontier benchmark today. So how do you tackle that?
It's a quarter of my fund today, which is quite large. I think in the benchmark it's about 17% or so. So it's a very big bet from us. It's a very cheap place to invest at the moment because it's overlooked by most people. It's in the Goldilocks period. It's benefiting from many tailwinds. Even Chinese companies that are trying to bypass the tariffs that Trump is putting on are rerouting goods through Vietnam to export to the US, tariff-free. So there's all sorts of little dynamics. And interestingly, the biggest concern is we wake up and Trump's tweeted, Oi, Vietnam, your trade surplus is getting rather large with us. But he tweeted 4 months ago, I encourage everyone to move their manufacturing from China to Vietnam. So I feel fairly comfortable at the moment. So yes, it's in a very good place at the moment, and it's been very well managed, having learned the lessons of many short cycles previously. Real wage growth of 5% means the consumer is doing really well there as well, and so we're all in at the moment.
Nick, maybe turning back to infrastructure. Perhaps a few people would see infrastructure investing as a bit of a bond proxy, with interest rates where they are, with gilt yields, treasury yields where they are. How does that play out for infrastructure over the next couple of years?
So interestingly, we are short-term price sensitive to movements in bond yields, right? No doubt about it. A lot of the infrastructure is very long duration assets, so as bond yields come down, the value of those assets goes up. But interestingly, the bulk of our universe is in those regulated utility companies. And each time they go back to their regulator, in the UK here it's every 5 years, but it changes around the world, anywhere from a year out to 5 years. The regulator resets their allowed returns to the current bond yields. Right, so in the medium term, these companies are neutral to changes in bond yields, and they pass through their financing costs in the prices they charge for electricity and so on. So the broad context is, in the longer term, we don't care where bond yields go, because we are making a margin on the way through, and that's set by formula in regulation. In the nearer term, we run an unconstrained portfolio construction process, and that allows us to shift capital from place to place as bond yields start to move around. So, for example, if we take the view that bond yields are increasing in the US and maybe real bond yields are increasing because the economy is getting better, then we sell the utilities and we buy economically sensitive infrastructure, and we make money on that trade because the market starts to increase the price of the infrastructure because it's getting more top-line revenue growth. If we take the view that yields are increasing in the US and it's more of an inflation thing and we want to get out of that market, then we've got the flexibility to do that. We'll shift our capital into the UK or into Europe, where certainly bond yields are going to be lower for a long period of time. And that's the message I would leave with you. We certainly don't have any concerns that we're going to get a sharp back up in yields or in inflation anywhere around the globe, certainly over the next few years.
I think being able to respond to how the market is developing is actually very important in a trend that's emerging like that. But I mean, the winners and losers, people often talk about a VW versus a Tesla, right? You're oversimplifying the problem there. It's actually easier to look for winners and losers if you consider the whole supply chain of an electric vehicle or the changes we're seeing in the shipping industry, for example. An electric vehicle is powered by an electric motor. Electric motors need a lot of power semiconductors. They need rare earth metals to make the permanent magnets. There's a lot more electronics in general in an electric vehicle, especially in an ADAS-enabled vehicle or an EV vehicle. There's lots of these niche little businesses like cameras, where there's probably only 3 incumbents making cameras to auto grades. It's much easier to look for opportunities in those sorts of spaces where you don't have to worry about over-competition. Instead, you can think about some of the barriers to entry. And actually, the auto business in general, because of the huge safety requirements you need to build a car, is a huge barrier to entry business. It takes you 2 or 3 years to get designed into a car. Once you've got into the car, you're pretty sure that you're going to be in the car for the life of the model, and then it just becomes a question of volume sold.
Please join me in thanking Hannah, Nick, and Oliver. Thank you very much.